Before we begin, a quick reminder, all information in this video is for educational purposes only and is not financial advice. Now, let's get into it. Today is the last trading day of the year, December 31st, 2025. While most of the world prepares to celebrate, behind the scenes of the global financial market, something is happening that has arguably never happened before in history. The system is breaking. It is breaking quietly without screaming headlines on nearly empty markets. This is not a forecast. This is a chronicle of events happening right now. You are on New Era Economics, and this is possibly the most important emergency investigation we have ever conducted. Subscribe to learn more. Our investigation is just getting started. In this video, I will show you 5 deathbed signals from the silver market, 5 undeniable pieces of evidence that, I believe, prove that on January 2nd, this market simply will not open as we know it. And the 5th signal explains why this is all happening right now. Let me be clear. When I say will not open, I don't mean the lights won't turn on at the exchange. I mean something far worse. It will cease to be a market. The exchange could declare force majeure, enable liquidation-only mode, halt trading, and even retroactively cancel your profitable trades. For you, as an investor, this would mean the market is effectively closed. Your paper profits would evaporate. So, here are the 5 signals that prove we are on the verge of this event. The first and most obvious signal is that a single price for silver no longer exists. The market has fractured. Right now, as I speak, there are 3 different realities, 3 different prices for the exact same asset. The first reality is Shanghai. Here, where they trade real physical metal needed for factories, the price has reached the equivalent of $84 an ounce. This is the price of industrial famine. The second reality is New York. Here, on the COMEX exchange, where they trade mostly paper promises, the price is frozen at $72. This is the price of illusion. And there is a third reality, Dubai. This is the center of physical trade for private investors, the street market for those who want to get metal in hand with no questions asked. And here the price is $79. This phenomenon has a technical name, super backwardation. But let's forget the terms. In plain language, it means the market is screaming, I don't care about your promise to deliver silver tomorrow for $72. I need the metal now, and I am willing to pay a $12 premium for every single ounce to get it. Imagine you are standing in front of a burning building. A firefighter offers you 2 options. I can give you a glass of water right now for $100, or I can promise you a water tanker tomorrow, but for only $10. What would you choose? You would pay the $100. The price of the future is irrelevant when your reality is on fire. This is what we are seeing in the silver market today. It is the financial equivalent of a burning building. The single unified market is broken, and its fragments are showing us the true price of panic. The price fracture is merely the reflection in the mirror. But what is happening inside the room itself? What is happening in the physical world? This brings us to the second signal, which is perhaps even more alarming. This is not just demand. This is a run on the warehouse. In the course of my investigation, I analyzed the daily reports on metal movement in the COMEX exchange vaults. Usually, these are boring numbers, a few 100,000 ounces moving from one account to another, but the data that came out yesterday is unlike anything I have ever seen. In a single trading day, notices were filed for the immediate withdrawal of 9 million ounces of silver. But the key here is not the number itself, as huge as it is. The key is the type of these notices. In exchange jargon, 90% of these orders were flagged for load-out. This is not just moving metal from one category to another within the vault. This is a direct order. Bring the trucks, load the bars. We are taking them out of your system permanently. 9 million ounces in one day. Let me give you a sense of scale. This single move wipes out nearly 20% of all the available for sale inventory, the registered category in the United States. This is the equivalent of every 5th barrel of oil disappearing from the country's strategic petroleum reserve overnight. Who is taking this metal with such desperate speed? It's not small investors. Only whales can move this kind of volume. Sovereign wealth funds, industrial giants, or perhaps the banks themselves, trying to find any real metal they can to cover their liabilities. They no longer want to play the paper games. They no longer trust the exchange's promises. They are taking the physical metal while they still can. They understand that in a burning building, the only thing that matters is the real glass of water you are holding in your hand, not a promise for a tanker truck. And this run on the warehouse is happening at the worst possible moment for the exchange. Its shelves are already practically bare. As we've previously established, years of structural deficits and industrial famine have drained inventories to critically low levels. Imagine a bank that has only one last gold bar left in its vault, but has issued 100 deposit receipts for it. As long as everyone is just trading the receipts, the system works. But what happens when a line of 20 people forms at the door, each one demanding the physical bar? This is exactly what we are witnessing. The line has already formed, the trucks are at the gates, the warehouse is being emptied in real time. And this is the second deathbed signal. When the warehouse is being emptied, it means that someone who promised to deliver metal cannot fulfill their promise. Someone is facing a massive loss. In our case, it's the large commercial banks that have spent years selling paper silver they never actually had. The run on the warehouse is, in essence, a margin call on the entire system. And this brings us to the third signal, a signal that the problem has escalated beyond the silver market and has reached the highest level of financial authority. They are being bailed out. Right now. How did I discover this? My investigation once again led me to the plumbing of the financial system, the repo market, and the data published this morning by the Federal Reserve Bank of New York recorded an emergency, unscheduled injection of liquidity into the system to the tune of $29 billion. Officially, of course, this will be called a technical operation to maintain stability. But you and I know what this really means. This is the fire department. These are the financial paramedics making a direct adrenaline injection into the heart of a dying patient at 3 a.m. Let me explain what happened. The banks, faced with the choice of either finding physical metal, which doesn't exist, or urgently buying back their short positions at an exploding price, were on the verge of insolvency. A multi-billion-dollar hole had opened up on their balance sheets. If even one of them had collapsed, it would have triggered a chain reaction, just like in 2008. It was at that moment that the Fed intervened. These $29 billion are not help for the market. This is a secret, ultra-cheap line of liquidity extended to specific insolvent banks so they could patch their holes, survive the night, and not bring down the entire global financial system before the opening bell. This is the strongest proof that the situation is out of control. Central banks do not intervene in the market in the middle of the night for minor issues. They do it only when they see a threat of systemic collapse. For decades, suppressing the price of silver was an incredibly profitable business for these banks. But now, that game is over. They are caught in a trap of their own making. The third signal is undeniable. The fire in the burning building has become so intense that they are now dumping money on it from a helicopter. But this only fights the symptoms. It does not solve the fundamental problem, the scarcity of the real physical metal, a fractured price, empty vaults, a secret bank rescue. So far, we have been analyzing the symptoms, but throughout my investigation, I kept asking the main question: why? Why is all this chaos happening right now in the last week of December? And the answer I found changes absolutely everything. This brings us to the fourth and most important signal. This is the root cause. Tomorrow on January 1st, a new law passed in China several months ago, but almost completely ignored by the Western media, comes into effect. This law officially classifies silver as a strategic national security metal and imposes strict restrictions, effectively an embargo on its export. Let me explain what this means. For years, China has been not only the largest consumer, but also one of the largest producers and refiners of silver in the world. The Western financial system has grown accustomed to assuming that, in a pinch, metal could always be sourced from China. But now China is flipping the switch. They are officially telling the world, our silver stays here, we need it for our future. Why are they doing this now? My investigation has revealed two critical reasons that have converged at this single point in time. The first is the Samsung Intel. As we've discussed, the announcement of their new solid-state battery requiring up to 50 times more silver was a shock to Chinese automakers. They realized that the technological race for the future EV market is, in essence, a race for silver stockpiles. By shutting down exports, China is ensuring that its own giants like BYD and CATL will have the advantage. But the second reason is even more profound. It's not just that China wants to keep its silver, it's that they don't have any left either. Analyzing the inventory data from the Shanghai exchange, I saw the same picture as on the COMEX, a precipitous drain. They are not just closing exports to hoard a surplus. They are closing them because they themselves have vacuumed up all the available metal from the world market and are now desperately trying to hold on to the last remaining scraps. Think about that. The world has just, in effect, lost its main supplier of silver in the midst of an unprecedented shortage. This is the equivalent of Saudi Arabia announcing an end to all oil exports. And the panic we are seeing on the COMEX, the run on the warehouses, the emergency bank rescue, this is the delayed reaction of those who understood it last. They have suddenly realized that the game has changed forever, that the spigot from which metal could always be sourced has been turned off. The first three signals we dissected are the desperate fight for the last few ounces of silver remaining in the West. But the fourth signal tells us why that fight began. The door to the East has slammed shut. And now all market participants are locked in the same room with a rapidly depleting supply of oxygen. And so we arrive at the finale, a fractured price, empty vaults, a secret bank rescue, and the Chinese export ban. These four signals are already established facts. They paint a picture of a system in agony. This brings us to the fifth signal, a signal of something that has not yet happened, but which, as my investigation shows, is overwhelmingly likely to happen when the market opens on January 2nd. When trading resumes, the algorithms and traders will be confronted with the new reality we've just described, and the reaction will be instant. The price will not rise. It will gap up, instantly jumping to the $80 level or higher, trying to catch up with the reality being set in Shanghai. At that moment, the banks holding short positions will be instantly insolvent on paper. Their losses will become not just large, but systemically dangerous. And to prevent a full financial system collapse, similar to what happened with Lehman Brothers, the COMEX exchange will, with 99% probability, do the same thing they did to the nickel market in 2022. They will pull the emergency brake. First, they will halt trading, freezing the market for hours, or even days. Second, they will likely declare liquidation-only mode, banning all new purchases. And third, the most cynical move of all, they may retroactively cancel all trades that occurred during the price spike. What does this mean for you? It means if your brokerage account shows $1 million profit that morning, it could simply be erased, as if it never happened. Everyone who profited from the rise will just have their money returned, but they will not be given a single ounce of precious metal. Your paper profits will evaporate. The market as we know it will cease to exist. These 5 signals are not a forecast. They are, for the most part, a statement of events that have already happened and their logical consequence. The market mechanism is broken. The game, in which you could easily exchange paper money for real metal at a price set in the West, is ending. And this brings us to the ultimate conclusion. The question is no longer, how many dollars will silver be worth? That question becomes meaningless when the very ruler we are using to measure, the dollar, is cracking apart. The new, correct question is, what will I be able to buy with an ounce of silver when confidence in paper money is finally gone? Understanding this is your ultimate survival strategy. Stop looking at the minute-to-minute price fluctuations in dollars. Start thinking in terms of real value. Watch the gold-to-silver ratio, which is our historical compass. Aim not for dollars, but for the future ability to swap your silver for real, productive assets, for land, for shares of functioning businesses. And beware of unobtainium. The risk today is not that silver might fall in price. The risk is that a day may come when you simply cannot buy it, at any price. If this investigation has opened your eyes to the events unfolding behind the holiday curtain, subscribe. We are only just beginning to understand the rules of survival in this new emerging reality. Thank you for watching, and I'll see you in the next video.